Welcome to the Ty and Rye the Finance Guys podcast, covering weekly investment news, important financial topics, and expert interviews. We want to help you become more knowledgeable about the financial world around you. This is not an offer to sell you anything, and remember, past performance doesn't indicate future results. Now your hosts, Ty Hansen and Ryan Robertson.
Happy New Year, Tyler.
Hey Ryan, how are you?
I'm just great. You know how I am.
You recovering well enough?
As best as I can.
Good.
You know how that goes.
All of our listeners wanted to wish you well.
Did they really?
Because they knew that you were suffering and in pain.
Yeah. Funny thing is, I wasn't in suffering and pain till last night. I was just telling you that. It took a week.
Well, but they didn't know that. That's what
no. I'm just saying.
The listeners don't know that. So.
Even after coming out of it, I was fine until last night. It's like, okay, guess the pain was holding back until now. I'm fine. I'm fine now.
Or the drugs finally left your system.
Yeah. Oh, they did. They put some serious stuff in my. I had knee surgery, but anyway. But they put some serious stuff in there. I couldn't feel my leg for 5 days.
Dude, that's crazy. So crazy.
It was awesome. It was awesome.
That is pretty awesome.
Yeah.
I'm glad it went well. Glad you're back at it and in the swing of things. And I even just saw you a second ago before we started recording, get up and walk around a little bit. So that's good. It's very good.
Yeah. I'll be at pickleball in 10 months.
I love it, man.
Yeah.
Come up, we'll play some pickleball up here. Or I'll come down to St. George.
That sounds great. Let's do it.
I love pickleball.
Yeah.
So.
Well, we got a whole new year to start on. And actually,
we do.
Today is all we're going to do is review last year.
Yeah.
The awesome year of 2021.
2021.
Man,
a little year that could.
Yeah, a lot of people didn't like 2021. I don't know. It's fine.
I know. Seriously.
I don't know what's wrong with it.
Well, I mean, you did have knee surgery, so there is that.
But 2020 was way worse.
Oh, I totally agree. I love 2021. I thought it was great.
Yeah. So we're going to review that.
Sierra finished law school and started her own practice, and she's going to be the sugar mama now. So I'm ecstatic, dude. I couldn't be happier.
Yeah.
Prosper's doing great. We got our podcast up and running. Hell yeah, 2021 rocked.
See? For all of you that are looking down on it, and granted, there's probably some people that have a good reason to look down on it. But if you're just complaining to complain, we're going to tell you all the reasons you shouldn't be complaining.
In the words of Danny Elfman,
who is...
Quit complaining, brother. No one lives forever.
Who's Danny Elfman?
You don't know who Danny Elfman is? And you, the musician. He's the lead singer for Oingo Boingo. He's the singing voice of Jack Skellington. And he's done like the Simpsons theme song. He's done tons of music in Hollywood.
Oh, sorry.
Oingo Boingo. Anyway,
I know Oingo Boingo, but
I love Oingo Boingo.
Never got into Oingo Boingo.
Really, really good band. Really, really good band. So, it's a dead man's party. It's a dead man's party. Who could ask for more? Everybody's coming. Leave your body at the door.
Wow, you actually are holding the tune. Can you sing?
So, a little bit.
Sounds like
they try to get me to sing with the church choir, and I tell them no. All right. 2021 financial highlights. Let's get to it.
Let's get to it, and we may have Ty sing us out of this today too. So stay tuned. Amazing Grace. There you go. Yeah.
No,
that's good.
We're not gonna do Amazing Grace. Okay.
You know what? Hey, let's do this. Let's start with the biggest stories, the biggest highlights. You know what? Let's start with what were the best parts of the market 2021.
The best parts of the market. So, okay. And I've asked this a few times on the podcast, but I keep asking people this question. I'm like, what do you guys think was the best section of the market, right? We call them market sectors. Mm-hmm. Right. Depending on who you ask, there's basically 10, 11, 12 market sectors. I break it down to about 12 market sectors. And so when you ask people, everybody's like, oh, well, yeah, dude, Ty, it was tech. It's definitely tech, right? Tech won, right? Tech was 4th place last year.
That doesn't even get him on the podium.
No, they didn't even medal, man. Come on. If you're in 4th place in the Olympics, do you get the medal? No, you do not.
I mean, if you get the bronze, nobody cares about you.
Hey,
but 4th place.
Speaking of which, doesn't the Winter Olympics start like in a month?
Yeah, got the Winter Olympics coming up,
dude. Winter Olympics are so fun, dude. That's so cool. Anyways,
they're all right.
So you wouldn't even get a bronze medal if you were technology last year.
Yeah.
The big winner was energy. Energy kicked butt, 60% plus last year.
Yeah, Red Bull,
Right.
Bang, Monster. Yep. Those guys did great.
Wrong energy.
Oh,
all the
gotcha.
All the bros that wear flat brims.
Yeah.
All the bros.
That's who won.
No, not that. That did not win. No. Not those bros. Like Exxon, Chevron.
Oh,
like that kind of stuff.
Yeah, the guy's ruining our planet. Gotcha.
Yes. Not a very eco-friendly win for the market. The craziest, like I said, it was over 60% last year. And then the other thing, too, is already year-to-date, 2022, energy's having a great little run. So I think it's going to continue because we're going to talk about it in just a minute, but inflation, right? It's a big deal, and it's interesting what happens with inflation and what it does with energy. So that was the big deal. I mean, really, it was funny because the sentiment coming into 2021 was inflation. This post-COVID high is going to end. Doom and gloom. Most people were hopeful that we'd be between 5 and 10% return on the year.
Yeah,
dude, the market ended up over 25% last year.
Mm-hmm.
Right.
Yeah,
that's why I say the little investing year that could.
Yeah.
Right, and it was kind of like had some fun little sharp spikes and drops, and it was. I would say it was a more volatile year. But I have my own theories about that as far as, that there's more. We're seeing an increase in volatility because of the access to trading that more and more people have.
Is this a conspiracy theory or like a real theory?
No, I think it's a real theory. I mean, it's not conspiracy. I mean, in fact, I've got market data on it. If I ever, study and do a PhD, I'd probably write my PhD thesis on this.
But why should someone trust you, Ty, that it's not conspiracy? Are you an expert in this field?
You don't have to trust. I wouldn't trust me if I were you.
Okay.
I'm just a bonehead on a podcast. You know what I mean? And any Joe Schmo can do that. So, but no, it ended up being, all things considered, it was a really strong year. And so yeah, I mean, that's what I'm saying. It was, the markets did well, largely driven by, energy and second place was real estate. Financials did well. Tech was in 4th place. Consumer spending was good. Materials were good. But really, and that's what I'm saying. All those pieces I just talked about were over, except for materials. Building materials was just under 30%, but basically everything was 30% plus return last year in those pieces of the market. Yeah. So with really, I mean, large cap led the way. Small and mid cap were kind of in that 20% range return last year. It was interesting too. Here's another little side note. There was kind of this battle, and so go compare like a large cap growth ETF and a large cap value for anybody wanting, anybody looking for something interesting. Go do that for 2021. Just look at
very interesting.
Don't do the 1 year. Don't do year to date. Just go search the timing last year's data. Right, which I think it started trading January 4th through December 30th. Check the trading data for large cap growth versus large cap value. And what's interesting about it was there's you see these switches throughout the year. It was almost like as soon as people kind of stopped freaking out about the inflation in February, March-ish, it shifted from this value play to growth, right? So growth all of a sudden hit a huge stride. Then about September, when the markets got a little bit more volatile, it started to shift back. Mm-hmm. So anyways, it's pretty funny watching this change in market ideology and kind of the sentiment in the markets as far as value versus growth. I personally just looking at the data, looking at the trends, and with the continued fear of inflation, I think that we're going to see more value play in 2022 than we did in 2021. Anyways, that's just my thought. So. That was kind of
this is a good point to bring up. How about you go into talk about growth and value? What do we mean when we say growth and value?
Yeah. Okay. No, that's a great point. So the very, very basics are
basics.
Growth growth is like it's taking more risk, right? Stocks it will take, like tech stocks are definitely more growth oriented, where you're going to have like a higher price to earnings because there's a little bit more speculation around it. Maybe your debt to liquidity, your liquidity ratios may be different. Your debt to income ratios may be a little more aggressive. And the idea is like kind of this new shooting star, like newer technologies coming out, or I just keep going back to tech, but more risk, more reward.
And think about it in terms of, I guess, dividends is one big part of that. A growth company, what do they want to do with their excess capital?
They're going to reinvest it.
Reinvest it for more growth. Yep. And,
absolutely.
That's why.
No, that's a good point.
We talk about energy companies, right? They're going to have some that's going to go out into more growth, but they're producing profits off of current infrastructure, so they're going to be paying out dividends at a little higher rate.
So, and as we shift over talking about value stock, right? Large cap value, kind of like what you're talking about with the dividends. I like that you brought that up. Dividends, you definitely see more dividends being paid out in value type companies versus growth companies, because again, the value's there, right? They've been there. They're steady eddies, the blue chips of the world. They can pay those dividends. You see a lot less debt. Price to earnings are a little bit more in line. It really is kind of more of the, like I said, the blue chips, the Coca-Colas of the world, right? The Walmarts of the world. The things that they're not fun and sexy, but they're just more of the steady eddies, right? And they can still have good returns. It's just, I think the big difference is large cap growth. People are thinking, I want to hit the cover off the ball and have a really good return.
Yeah.
Versus the growth is a little bit more like, I'm going to have a good return, but it's going to be kind of boring. So,
yeah.
But, again, it was a good year, and that's why I say it's kind of like it was the little year that could, right? Little engine that could last year, because everybody was so freaked out coming into the year. And most analysts were like, "Hey, we'll be lucky if we can get over 10%." And like I said, it ended up over 20%, 25% plus. Like, it was a really good year. So, and I would also say too, kind of the three main stories, the three main pieces of the year that really kind of had things in just flooding the headlines were crypto, right? Crypto kind of made its resurgence last year. Meme stocks and inflation, right? Those were the key pieces of 2021.
Yeah.
So,
well, I was we were talking earlier about it, but the crypto meme craze felt like a long time ago, actually. And it seems like it was the first part of the year. We were still kind of in the lockdown stuff. There was the winter time.
Yeah.
People in front of their computer maybe halfway through the year. I haven't seen a whole lot. There's been a little some stories here and there with crypto, and I haven't really seen any meme stocks since then. I think people are just out living life again, and they're like not fixated on how am I going to hit the lottery with?
With crypto, I love that you said that, and that's such a good point. I didn't even think about that, right? And you're right. More people were sitting at home, like not working and getting government stimulus, thinking, what can I do to make $1 million?
Get that stimulus check and shove it into some crypto.
Yeah, exactly.
Because I think
now we're all back to reality.
Yeah. Well, we could talk. I mean, the crypto craze. I mean, it's never going to really go away, likely. But the things that came into kind of the mainstream was Ethereum and Dogecoin. People kind of heard of Bitcoin for a while, but those two kind of came in and made a big splash because you got Elon Musk talking about it, and the price going from literally nothing to like 70 cents, which is just 20,000% returns. Like 6 months.
Exactly. Yeah.
So,
what's interesting too is, when we first were talking about cryptos earlier in the year, as we were seeing the crazy, FOMO rush on cryptos, way crazy volatile swings, things like that. It's like, we definitely took more of a pump the brakes kind of mentality. I actually am starting to feel and get more information. I think there's going to be a place for cryptos long term, right? Yeah. And not that I've changed my tune that I feel like it's still crazy hella speculative, right? But I actually feel more confident today than I did, 8 months ago about it holding its place within the actual market, right? Maintaining a value within the marketplace. Just like tech stocks, right? Tech stocks are there, right? They're a market sector. It's part of the market, right? I think we're going to definitely see cryptos hold their place longer term. Now, which of the cryptos, if like what ones are actually going to be around, what aren't, the speculation's still insanely high, so it's like, buyer beware, but yeah.
Well, yeah, so if you think of like
crazy.
Bitcoin, I mean, just look at these swings. If you look at the monthly returns,
Yeah.
like 5
Right.
years, it's 4,000%. So that's kind of crazy. Almost 4,200% returns in 5 years. Last year is only 36, which is still really good, but obviously not amazing.
Yeah.
Last 3 months, it's down 21%. Last month, down 11%.
Well,
last week, down 7%. Last day, it's kind of dropping off the table today. It's down
right.
5.5% today.
Yeah, I know, it's crazy, and that's the whole point. It's like there's no rhyme or reason to knowing when you should. Yeah. That's what I'm saying. I'm almost of the mindset now that it's like, look, if you buy it as more of a long-term play and hold, like, it can have a place in your portfolio. But if you're trying to time it, good luck.
Maybe.
So
see, if you watch it, it has these support levels. Like, it follows some trajectories on support levels and resistant levels and things like that. But the problem is that it solely has to do with just when people have bought, rather than some other sort of event that signifies why is a support level where it's at. Yeah, I get it's where people are
right.
Support levels where people are buying, right? They're willing to buy at that level and up, right? But with cryptos, it's like that's there solely just because that's where everybody was at. And you watch it, watch this happen, and it goes to those levels a lot. And so it's like people are buying it. Well, I know it's here. I'm going to buy it. I'm going to sell it. I'm going to buy it. I'm going to sell it. I'm going to buy it. I'm going to sell it. And I can imagine that this is. There's a lot more manipulation going on in these crypto worlds than we can probably factor because there's not any regulation on it.
Absolutely.
Nobody's looking at it.
Well, and not like that too. It's like, look at the valuation swings and price swings when you've got Elon Musk or other, big wigs coming out and saying, "Oh, we like it, we hate it." Do you know what I mean? And it's like, but I mean, think about this too. As cryptos and things like that are tied to technology, and Ethereum tied to blockchain and technology, that, in my opinion, is what's going to kind of weather the storm, right? Is as it starts to kind of carve its place into the market.
Yeah, it's still so murky to me. Like, I get the technology side of it. I get the fact that there's something there. I get it. But where does the application go from Bitcoin? Because Bitcoin's is a one-use, one-trick pony, right? Ethereum is malleable. It can be used for lots of things. So they both seem to have kind of a track of what they're going to be used for, and Bitcoin's really only use is going to be this one. You've got a ledger, and you're exchanging spaces on that ledger. And Ethereum's like, well, we can apply this to practical everyday use. Car titles, land title. I mean,
land. Yeah.
So
the other thing is we're not to get too far down this crypto rabbit hole, because we've got a couple other things to hit before we're done. But it's crazy to think too, the as we look at like the creation of the metaverse, right? And this whole like, like Ready Player One kind of a universe. Do you know what I mean? And so you start to think about the application in those worlds, right? And the NFTs, right? The non-fungible. What is? I can't remember the damn acronym right now.
Non-fungible
NFTs. It's
transaction.
It's like people wanting to buy these avatars and buy real estate in a non-existing world.
No, it's an existent world. It's a digital world.
That's exactly the point, right? I guess it is it is an existent, but it's like, anyways. So
our 40-year-old brains are having a hard time here.
Yeah, seriously. And all these little 25-year-olds, 20-year-olds are like, get with the time, man. You guys are so old and dumb.
You got to get in that.
We're all going to be living in the metaverse.
That metaverse and buy the Taj Mahal so you can sell tickets for people to virtually take tours. I mean,
well, we bought the Oculus for our kids for Christmas, and dude, VR is pretty crazy. It's pretty fun stuff.
So, I mean, that's kind of what you're dealing with these things, is that it does feel like the application of them can really be expansive. You know, it really can be expansive.
I agree.
And you look at, say, just how Bitcoin works. There can be an application in which it eliminates manipulation of currencies. I can see that. But nobody in their right mind is going to want to use Bitcoin as currency at this point, because the valuation fluctuates too much. You just can't predict what that Bitcoin's worth to trade it for something else. Yeah. So at some point, there's got to be some end goal with these things where it transitions into more concrete applications. But I don't know how far away that is. I don't know when that's going to happen.
Again, so I think there is this, even though it was crazy and it was a wild year, I'm definitely coming around to the fact that there's going to be some value in that crypto, longer term, right?
Yeah.
And I don't know to what degree. I don't know. So
who knows?
We'll see.
Ty, who really knows?
You
don't have a seer stone.
I don't have a crystal ball. We'll have to come back to this podcast in 10 years and revisit it and see what the hell actually happened.
See how big of idiots we are.
Yeah, exactly. Mm-hmm. So, I do want to take a quick minute though, talking about kind of the highlights of last year with the meme stocks, right? AMC, GameStop, and it's funny because I looked at it, and so in fact I've got the data right here in front of me. It's like, okay, AMC, it made 1,100% return
for the year.
Yeah.
Wow.
And GameStop was 700%.
Still, for the year.
Right.
That's bonkers.
So 11
bonkers.
times and 7 times. But here's the key, though. Here is the key, right? The key with that is that you literally what really just reminded me of how crazy the meme stock play is they're so quick and sharp and in and out. Like if you didn't hit those things just right,
it was massive consequences.
Yeah, and that's what I'm saying. It's like, I love that there was this idea of FU Wall Street and hedge fund managers, but the primary people that got their butts kicked were the investors jumping in, a week after the fact.
Mm-hmm. Yeah.
So, anyways, that was kind of just my quick thought on the meme stocks from last year. Is it was again, it's fine. You think there's value, great, go after it. But playing the game with a large percentage of your money there's no difference between that and freaking going to Vegas and putting all your money on red or,
No, black.
Yeah.
Red's fine. Black's.
Or black.
Yeah. You
black.
don't want to choose one of those.
You don't want to choose?
No.
Why not?
No, because
you don't want to put it on black? Why don't you want to put it on black?
Or red.
Or red.
Now listen.
Why don't you want to put it on either of those?
Because it just doesn't work that way.
Okay.
It's funny because I've had maybe in the last 3 months, I would say, a handful of people who started the year choosing their own stocks, who then came around and said, "Hey, can you guys just handle it for me?"
Right.
It's one of those things where it's always going to happen unless you are a professional and you spend a lot of time in that.
Right.
Right. Whatever is popular in January, probably not going to be popular in December.
Right.
Because everybody is getting on the bandwagon for popular, and you just don't.
Right.
The hard thing is to not know when to buy it. The hard thing is to know when to sell it, to get out of it.
I agree, and getting emotional about it, right? Hold on, I want to read it. I saw some really good quotes yesterday. So, Charlie Munger is Warren Buffett's right-hand man, right? Berkshire Hathaway, they're partners just like you and me, right?
Yeah.
And they were just sharing some quotes from the end of last year of some of his thoughts and stuff like this. And I love it. He said, okay, so I'm going to quote him on this. I thought it was so funny. And maybe I'm the only one that's going to laugh because this is what you and I do for a living.
Yeah, it is.
But he said, the general system for money management requires people. So again, people that manage money requires people to pretend that they can do something that they really can't do, and to pretend that they actually like it when they really don't. Right? It's a terrible way to spend your life, but at least you'll be well paid in the end. And I love that, because it's like, I mean, I like to think I know what I'm doing, and I think we do a good job, but I love that he talks about people who are pretending, and they also pretend to like it, because, oh my good hell, 9 times out of 10, it's like, I hate managing money. Yep. It is so freaking hard. It is so hard. And it is a terrible way to spend your life, but at least you make money. So
there you go.
Make money doing it. So.
Yeah. Way to tell everybody, Tyler, we don't know what we're doing. Good job.
Way to tell everybody the internal secrets. But yeah, you bring up a good point. It's like people get excited and they get all FOMO'd and they think they know what they're going to go after, and it's something that's hot and shiny, and that's what everybody wants, and they buy it and they don't know when to buy and sell, and they lose their shirt. So.
Yeah, just go back and listen to that whole series we did with the .com bubble. We did one on gold. We did one on real estate. We did one on the 2008 crisis. Like, you got to go back and look at it. This cycle of just the bandwagon investment comes and goes every so often. And you know, who was it that said, who's the circus guy?
Barnum
and Bailey. He's like, a sucker is born every 10 seconds. Is it him that said that?
Yeah.
It is him, isn't it?
I think it was, yeah.
It's somebody.
You mean Hugh Jackman?
Yes. You know, it's just one of those things. It's just like, we're so ready to jump on bandwagons for stuff. And it's kind of like, no wonder we got these divisions in the country. It's just, it's easy to manipulate people. Let's put it that way.
Right.
One way or the other. I'm not taking a side on any kind of issue.
I agree.
If you want to manipulate somebody, all you got to do is tap into their greed or their fear, and you got them.
Right.
So,
well, and that comes back to, and maybe that's our overarching pearl of wisdom from 2021 is, look, just stick to a simple system. There's a lot of thoughts out there with some basic trading systems, and it doesn't have to be flashy or sexy. It's just like, right. And if you stick to that, 9 times out of 10, it's going to win out. Right?
Yeah. That's why
don't be the sucker. Don't be the sucker that's born every 10 seconds.
I wrote that in our newsletter for the month. Conventional wisdom is not dead.
It is not dead at all, right? And we still did really well on the year. I was happy where we ended up. Now, here's an interesting thing, though, that really, like, what really kind of threw me last year, what was so difficult, it wasn't, and this is inflation, right? I want to talk about inflation for just a couple quick minutes.
Yeah.
This is what was so hard about managing a portfolio last year. It wasn't the equity side. The equity side, there were 2 or 3 times in the year where it was like we were in a 3 or 4% drawdown. It wasn't fun.
Right.
Clients are emailing and calling, yada, yada, yada. The harder thing in the portfolio was managing the more conservative or bond side of the market. Right?
Rough.
It was the worst. And in fact, we didn't talk about that, but the ag, right? The aggregate bond index was down about 3.5% last year, right? Bonds lost money last year for the most part. Why? Because everybody's freaked out about inflation. We know rates are going to go up, and so it's hurting the returns on bonds.
Yeah.
Right? You're not seeing a 10-20% swing, right? But nonetheless, you're seeing those losses. And here's the problem is people kept hearing, oh, the market did 20%, 25%. And they're like, oh, that's what I should have in my portfolio. They look at their portfolio and they're like, wait, I'm only doing like 10, 15, 16, 17%. It's like, but yeah, like you got to realize if you're hedging part of your portfolio, right? Most people used more conservative pieces.
Yeah.
And if you used any element of conservative pieces in your portfolio,
it's not going to work.
And you start to weight that, you start to say, okay, well, I've got 30 or 40% in something conservative, like a bond portfolio, right? Like corporate bonds, government bonds, whatever have you. Like then it really did a number. Because think about that. I mean, if bonds had done 5 or 6%, 7%, right, that would have kicked your average higher up to more like, you would have been 20, 21%.
Yeah.
And you would have been really close to the market. But because you had that conservative piece of the portfolio because of inflation that eroded your returns, it's like people were a little bit like, you start to see people kind of walk away from, conventional wisdom. And I guess my thought to that would be, it's like, look, back to the same point we were just talking about. You've got to have better expectations, right?
Yep.
It's like, I mean, goodness gracious, if you look at the last, people in my more kind of that mid-range, mid to moderate aggressive range, they've averaged in the portfolios about 16 to 17% the last 2 years with a lot less risk.
Yeah.
Right. And I look at that and I think, yeah, okay. Has the market, had some amazing swings in the last couple of years? Yeah, but it also had the pandemic sell-off. So my point is, it's like, you manage those expectations right, and you look at that over time. It's like, man, if you average more than 10% over a given period, like, as long as you're saving, as long as you're not being crazy and you're not chasing crypto, you're not chasing meme stocks, you're not chasing that unicorn out in the investment market, you're going to be just fine in retirement. Mm-hmm. Right. And so it was really interesting, really telling last year where, again, still a great year. The inflation kind of eroded that conservative side of the market. And people kind of were really frustrated with that. So
yeah, it's tough. It's tough because if you were in a conservative position, and anytime inflation starts to really come in, it is tough to stay ahead of inflation without taking on risk in the equity markets. It's hard.
Totally agree.
So, you really got to assess some of that. And, and if we do see inflation start to cool off, we're still going to see some interest rate risks that are going to affect those markets still. So,
yeah,
that's the kind of thing you got to take into mind when you're starting to think about, well, I want to take on less risk. I got to be more conservative. You got to assess that, because that's going to be a part of this for the next year and some.
Yeah, I'm glad you bring up a really good point, right? And that's, as we kind of start to even look into 2022, it's like, how do you account for that? Because we know that bond side of the market's going to continue to get beat up because we know interest rates are going to go up, right? Fed's talking about it. In fact, even today, right, as we're recording this, at the end of this day, the market's kind of got beat up a little bit because some of the Fed notes were released from last December.
Yeah. Yep.
And so the idea is we really, like, I don't want to say you have to get creative, but like, this is where the fixed annuity comes into play, things that are going to still generate that foundation where it's going to give you that return no matter what, right? Those kinds of things. I guess what I'm getting at is because that conservative side of the market is going to be so volatile even coming into 2022, I just think that the need for, really understanding what you're doing in your portfolio, what we do, portfolio management, I just think it's going to be more important than ever, because you can't just really set it and forget it, because we know the bond side of the market's just going to get beat up, right?
Right.
You got to have a better strategy in place to really kind of weather that conservative side of the market. So
yep. And that's the kind of thing you got to really bring up with the person that's working with you. Talk to them about that and say, look, I understand the conservative side of it's going to be pretty tough. So what do we do to hedge against that? That's kind of what you're looking for in this year.
Absolutely. Yeah. So it was a crazy year. Still made some money. Glad we made money. But it's going to be interesting to see what happens in 2022. So
that's right. We're going to have fun for this year too.
Party.
I mean, I plan on it. I don't know if you will, but I will.
I mean, once you're back in the saddle and you can, run around and cause trouble, I think you'll have fun this year. So
yeah. Oh,
I'm
hey,
planning on having fun.
Let's do the contest. This is going to be the first big update for the contest we started, the ETF one. Let's hurry and do that.
Absolutely. So just a quick note, one of the positions that were picked is down because remember, it's the opening December 15th. There's a position that's down about it is the VCLO. It's a cybersecurity disruption ETF.
Ooh.
It's kind of like a cloud and cybersecurity ETF. It's down it's down to over 15%. It's down.
Oh.
So it's getting its butt kicked.
Do we have some portfolios that are positive?
Well, that's just one position. That's just one position.
I know.
Okay. So overall portfolios, Penniless Bull is the winner. He's up.
Who?
About Penniless Bull.
Okay.
Penniless Bull. He's up. He is up 4.25% in that time frame. Right.
What's
we're talking
the market?
About a 3 week.
What's the market done in that time?
Here, hold on. Give me 1 second. I'll pull it up and I'll tell you exactly.
I want to see that.
Yeah, let's see. Okay, so the actual market itself in that time frame is flat.
There you go.
It's about
Penniless Bull making money.
Penniless Bull. He's about 4 times up on the market. So good work. The biggest loser is D-Tar.
D-Tar?
D-Tar.
Uh-huh.
He's down about 9%.
Oh my goodness.
He's down about 9%.
I can feel there's going to be a comeback there. There's going to be a comeback there. There's 10 days left. Today's the 5th. We got 10 days.
I'm excited to see. Yep. Anyways, so that's where we're at with our people. Everybody that's in there. It's been good.
Okay, so how far back is second, third place? Who's second, third?
I'd have to. We'll share that one next week as we come into the final week. Penniless Bull's up about 2% above everybody else. Because there's a big group of people in that kind of 1.5 to 2% range for return.
Oh, but they're up above the market though. Way to go, everybody!
Yeah. In fact, most people have done decent in the port. There's not too many people that have had big losses, but
D-Tar, look, buddy, look, D-Tar.
Hey,
don't hang your head. You've still got time.
Yep.
You've still got time.
I agree.
And I'll tell you, hey, you may be the biggest loser. There's a prize with that too.
That's right. We are going to get a prize for the biggest loser.
Yeah.
So we're having fun. It's nice. And again, what it comes back to is in 2022, don't ride the fad. Try and be smart about making sure you've got a good diversified portfolio and don't buy into all the crazy hype of whatever's the flavor of the month, right?
Yeah.
And be careful with what you're doing on that bond conservative side of your portfolio. That's the key takeaway. So
yeah, that's cool. I'm excited to see who's going to win this.
I am too.
Okay, next week I want you to put together first, second, third. Let's see where they're at because that's going to be the end next week when we meet. It's going to be kind of the last one before, so we want to see who did it.
I like it. We can do it. You got it, buddy. All right,
man. Appreciate your recap. A lot of good insight. Way to go.
That was fun. Appreciate it, man. And you just keep getting better. Keep healing up. All right.
I got to go ice my knee right now.
Okay, buddy.
All right. See ya.
Okay.
Hey, thanks for listening to the Ty and Rye, the Finance Guys podcast today. If you like what you heard, go ahead and hit subscribe. That way you won't miss any future episodes. Also, follow us on Instagram, Twitter, Facebook, Ty and Rye Podcast. Also, check us out at myprosperteam.com. Thanks. We will see you next week.